BMO Capital Markets Chief Investment Strategist Brian Belski is with us today, has an S&P target of 6,700 for next year. Brian, good to see you. Welcome.
Thank you so much for having us. Good morning, Squawk on the Street.
You do write a time for some common sense and prudence and even some humility. What is that about?
Well, so many of our compatriots, other strategists, economists, love to make the big market call. And they've been wrong just trying to call the market, and I think that they've really missed that the stock market is a market of stocks, and that's what's maintained our bullish stance, quite frankly, and consistently, and some people have called us stubborn, since 2009 when we came out with this call that U.S. stocks have entered a 25-year secular bull market. Now, it's tough to be bullish that long, especially given all the negativity and all the doubts. And in your first hour today, you had Mr. Cramer talking about sentiment being still negative, and it's true. And even the great Tom Lee, earlier this hour was talking about all the cash on the sidelines and investors really doubting this, Carl. And it continues. It just baffles me. But for our sense is this, is that the U.S. market, in terms of an equity asset, remains the best asset in the world, number one. Number two, you get what you pay for. Too many people are focused on valuation. Valuation is the world's worst metric in terms of forward performance. Number three, in terms of what we're going to be seeing over the next 3 to 5 years with respect to U.S. growth, it is going to be consistent. We may have other areas of the world that are seeing quote-unquote snapback growth, but in terms of earnings growth consistency, we continue to believe it's going to be the United States.
So that leads you to what, your $275 number on EPS?
It does. And our base case is 275, Carl. But we think that as we poll our clients and we look at other Wall Street research in terms of the financial sector especially, we think earnings in the U.S. financial sector are massively understated, with a big catch-up trade coming on the earnings front, with the broader theme of scale asset managers and broker-dealers, scale meaning the big banks, but also they're very small banks we think can do very, very well. And just polling our clients that we speak with, we continue to believe that the majority of clients on the institutional side are at best neutral, meaning market weight financials, and there's more to come there.
So you sort of poo-pooed the valuation argument as a reason to be cautious. So what do you think is then a reasonable valuation, and when do you start to pay attention to it?
That's a trap question, Sarah. Thanks for trying, but I'm not going to give you a number, because I think anybody that says 22 times is the number, that's simplistic math. The market is not as easy as coming up with a valuation metric and an earnings target. That doesn't equate to how you model markets. We model markets from a macro PE compression, longer-term PE trends, and a dividend discount model. When you take a look at a dividend discount model, we can squarely get to 6,700, especially where rates are going to go. With respect to where you look for value overall, we can talk about that. We've been bullish in print in the published marketplace for well over a year on small-cap stocks. Other people talk about small-cap stocks, but we've been in print on it. Why? If you take a look at all of valuation metrics, not just PE, if you look at PE, price to sales, price to book, price to free cash flow, operating metrics like return on assets or return on equity, Sarah, these small cap companies look amazing, and we're starting to see more and more broadening out with respect to performance there. From a fundamental perspective, we really think small cap stocks and mid cap stocks are going to do amazing over the next 3 to 5 years.